Well, hey guys, welcome to another episode of Beyond the Guidelines. I'm here with my partner in crime, Ryan, the man Speltz, the kick butt mortgage guy. And of course here, Jason Maxam at the Maxam mortgage team. And first of all, just wanted to welcome you to our show. And Ryan, why don't you say a few words, see what's going on in your neck of the woods.
Man, it's been a fun couple of weeks. I know you had got a little sick there for a while, so we had to take a little hiatus from the show, get your voice back. So
man, I'm back from the dead, guy. It's a week and a half. I don't know what it was. I mean, COVID, flu, whatever it is, whatever new strand is going on. It was a bummer, but glad to be able to talk and get out of the bed and actually leave my house. You ever just get stuck in your house for 5 days? You just want to lose it. You just lose your mind. That's kind of where I was. It's really great to be back and back in the swing of things. Been pretty busy. I don't know about you, Ryan, but it feels like it's just hard to get to everything these days. And it's a good feeling because, you know, as most people in this industry know, wasn't as busy over the last maybe 12 months or so. So it is good to see a lot of activity. Good to see a lot of realtors out there making some things happen, and a lot of our fellow loan officers doing some good things. So I think that's a great topic to transition to, is just to kind of get a take on what we're seeing in the market right now, both where I am, which is in Alabama, and where Ryan is in Florida. What are you hearing? What are you seeing? What are you feeling?
Yeah, I think there's quite a bit going on, man. And really, you know, we've obviously seen the major swings in the market over the last couple of weeks of, you know, I remember you and I were together when the administration announced the tariffs, and we saw that huge couple of days of red in the market, which, you know, it traditionally for us is like, while it sucks for a lot of retirement accounts and 401ks and you know, in the short term and that kind of stuff, it's traditionally good for mortgage rates because generally people are flighting to bonds as safety. Interestingly enough, the following Monday, we saw the exact opposite reaction and ended up, you know, going into a situation where we saw the rates flip considerably quickly. And, you know, I've got a couple of loans in right now that weren't locked at that time because they were clients that were trying to hold out for best possible scenario with the trajectory of the market the way we saw it. We noticed that it was hopefully going to continue to go that way. And then the surprise announcement of certain tariffs kind of sent it the other way. It was a 3 discount point swing for that client, almost $12,000 on a $400,000 loan that we just haven't been able to get back to even where we were when we started the loan process. And luckily that's a refinance, so there's not too much long-term impact for them. We just wait it out and hope that the rate comes back, and then we close it when it does. But those kind of scenarios really suck when you're in a purchase transaction. And I think that's kind of where everybody is in a wait and see environment right now. And going into the spring, we traditionally see an uptick in client activity and people wanting to move because kids are done with school and all of that stuff. And I think you've recognized that over the last couple of months of really getting focused on the right aspect of improving the business and seeing some good activity from your real estate agents.
Yeah, that's a great point. And it just goes to show you that, you know, even experts like ourselves that are in the market, watching the bond market, watching how the stocks are, you know, reacting to, you know, really uncertainty, new administration, you know, new guidelines, regulations, you know, tariffs. There's just a lot of things that are going on, and it's really hard to wrap your head around these things. But I'd like you to expand. That was a great point. I'd love for you to expand just for the layman on how bonds and how interest rates are correlated, because I think it's important for people to know when people start hearing about recession, we start hearing about slowdowns, we start hearing about negative GDP, we start seeing those stock markets and risk on assets start to go down. It's actually a benefit on our side in terms of affordability from interest rates. If you don't mind, like, just kind of give us just a rundown of how the bond market or 10-year treasury, how it correlates to interest rates.
Yeah, and you know, I'm trying not to get into too much technical aspect of how that works, but you know, in the grand scheme of things, generally when the treasury yields are down, rates are going to be better, right? MBS securities get a boost in their price, and people want to flock to them and really take on that kind of debt. That's what's been interesting really in the market, is watching this. And I just pulled up the chart, and we have you know, basically the 10-year on that day I was talking about, that Friday, April 4th, the 10-year had gotten all the way down to 3.86. 3.86% is what the marker there is. And then on Friday, April 11th, so exactly 1 week later, we had a treasury yield at 4.89%.
Which, by the way, is unheard of in
Yes.
the bond market. Usually we'll see an 8 to 12 or even 15 basis point move. It's a big deal in the markets. We're seeing whipsaws between 30 and 50 basis points right now. I think we had a day where it was almost 100 basis points. So we're literally, when we're talking to customers about interest rates, I think we had a dozen refis that we were ready to go. Everyone thought the interest rates were about to come down. We started selling some refinances. We were about to set them up. I remember we had a deal going. The minute that we hung up, interest rates got 3/4 worse.
Yeah.
It was unbelievable.
Between that Monday, so the following Monday, the 7th, the 7th.
Hey, Ryan, why don't you go ahead, just share your screen real quick. Let's show everybody what you're looking at.
So the day of the 7th is right here. And
right, so explain to someone who doesn't know what they're looking at. So this is the 10-year treasury.
Yep. Yeah. So this is the 10-year treasury of, this is what basically pricing kind of operates off of. So you saw, we kind of hit a little bit of a high back here, almost approaching, 5% back here in January. And we recognize that in rates, right? We saw super high rates in January, or, we were well over 7 and we started climbing and clawing back. So as this comes down, the rates kind of get a little bit better. And we got into here in March and we were like, oh, mini refi boom. And I think we had like 3 or 4 days in there where we got, great pricing and we were able to lock a couple clients in. And that same refinance that you talked about was hanging around in March as well. And we were, this close to getting it started, and they decided they wanted to wait it out a little bit, and then boom, right back up. And then,
let's show that V bottom right there. So we've got a bottom out right there, right? So we see that's the lowest rates that we've seen. Gosh, I can't see the other side of the chart, but it's the lowest we've seen in a really, really long time. And guys, look at that. In a matter of days,
that was back in September when we had that.
Yeah, so we go from like a record low. I think it was a 4 or 5 month low, and then in a matter of days, it shoots right back up. So I think the importance of really understanding this, and not to get too technical, Ryan, like you said, but in order to really understand how the market works, that's going to reflect, especially depending on who you're working with, right? You want somebody that really kind of has a general understanding of what's going on in the market and how it affects interest rates. So I think this is a great chart to look at, because it does a couple of things. Number one, it shows that there is incredible volatility, and it does affect markets as a whole, but specifically interest rates.
Yeah, and you can just see like where generally pricing is, right? You're watching it go from, where it's been 4.5, the chunk of it is at the high end 4.5 down to, 4.1. That's kind of where we've been hanging out for quite some time. When it dips below that, we see those tremendous dips in rates that we see over and over again. And this is the importance, like you said, of working with somebody that watches this stuff and understands it, more than, you as the buyer, or you even as a real estate agent, or even you as an LO, right? Working with somebody that understands it a little bit. We make the macro decisions of, okay, what's our focus going to be on for this week in trends, right? So we like we said, we start watching this downtrend. We go, okay, let's start positioning ourselves for refinances, right? And now we've got a low bottom, right? We're like, this is the best pricing we've seen in rates, but it was because we were having the conversations back here. So now we've got the trend. However, then we start watching on a little bit smaller time frame, and we go, okay, now we have to start making these rate decisions on the micro, not the macro, right? We want to start making these on the daily time frame of okay, this one's a pretty tough one to make a decision of like locking at any point in there, right? Because most of that movement happened pre-market before we were even awake, right? This one big green candle here where we saw, over 20 basis points, I think between 16 and 18 basis points of that was at like between 4 and 5 a.m. So we woke up to, oh God, it did a reversal. We have no chance of locking any of this, right? Because the lenders have already, when they come out with pricing at 10 or 11 in the morning, they've already we're not getting Friday's pricing on Monday anymore.
Yeah, extremely volatile market. And so, I think there's a couple good things that we can come out of this while we explain the this chart. And you could probably, you probably go ahead and take that down. But I think, a couple good things that come from this is, when we're talking to clients, we need to be very specific about, number one, the volatility of this market. We need them to understand that, the rate that I'm giving you today is not going to be the rate that you're going to get once you're under contract. These rates change not just daily, but sometimes hourly and sometimes pretty viciously. So it's important to work with people that not only understand the charts, but also lean on to other companies that are following this for us. Yes, I think the importance of really understanding the markets, generally speaking, because let's face it, Ryan, like me and you running a business together, there's, we have to wear a lot of hats. And one of the hats is not us having to watch the bond market 24 hours a day or watching what the 10-year is doing. So we pay a good amount of money to lean on to some of the best technical analysts in the business. For the mortgage guys that are watching this, you probably know who I'm talking about. So very important to have that on our team, and for us to be able to plug in and understand not only where the rates may be going, but what the trend is and how to explain that to a customer in a way that they understand it.
Well, and a lot of it as well is the emotional stability to do it, right? I think that's one of the biggest things. You get into the stock market and you watch these people that, they make bets, they lose, and then they go crazy, right? Like, because they can't control the emotion from day to day, and being able to, regulate that on the day to day. So when a client calls me and goes, "Oh my God, I saw the 10-year went up, 10 basis points. What's my rate doing?" Well, we locked last week because you liked the deal, and that's where we're at. And so you're able to have, take the emotion out of those conversations. And it's super important for real estate agents to understand too. You don't need to understand the market, right? But what you do need to understand is that you've partnered with somebody that does understand it, or they've partnered with somebody that understands it, and it's being translated through, right? It's the nice transitive property of information there. It's just making sure that you're positioning yourself with the right people so that you don't have to have those conversations. Because as a real estate agent, you should understand the macro trend and getting to know like what's going on in the market so that you can speak educated enough about it, right? And look educated about it. You don't have to know the numbers. You don't have to understand the movements. Just partner with somebody that does understand it.
Right. Yeah. And, the devil's in the details. But as for me, I'm not going to try to do a real estate agent's job. The good thing about a lot of the realtors that I work with and partner with, they know that they don't need to get involved on the number side, right? If a customer calls and says, "Hey, what are the rates doing? Hey, why are my closing costs this much? How can I get my mortgage payment down?" Those are the things that we take the burden from them. And our number one job is to make those realtors look good, right? At the same token, they want to try to make us look good. And that's where that team effort comes together. But
yeah, staying in your lane is extremely important. And then also, and I know that you do this as well, but trying to support the other person in the transaction, right? So when a real estate agent, when the client comes to you with a question about something, the real estate agent should be the answer on, "Hey, I trust their decisions 100% or their information 100%. Like, that's the person that you should talk to. Make sure you go back to them with it instead of trying to make something up that might not work out."
Yeah. I guess this is a good time to kind of move into like the real estate agents and the real estate market as a whole. So obviously we've talked a little bit about, the slowdown that we've had over the last year or so, starting to see the resurgence in the market and seeing a lot more activity, and, trying to determine like what is attributing to that movement. And, what are we seeing? Is it just because it's springtime and this is the normal season where we see that uptick? Do you think it's because maybe the interest rates are what they are and people starting to see that, hey, this is the new normal. This is where we need to start budgeting our house payments at. What are some of the things that you're hearing and seeing in your area?
I think a lot of it, all of the factors that you mentioned could come into play, right? Like all of that on a micro scale probably have something to do with a lot of the decisions that are being made to move out of that house that you bought with a 3.5 or 2.5% rate, and you're going to jump into a 6.5 or 7. Like financially, 99 times out of 100, if you're only focused on the financial part of it, probably doesn't make sense, right? Like I'm not refinancing a loan of my own to a 7%, right? It just doesn't make sense to do it.
Or moving out, right? Or you're not moving out to go leave a 3% rate or 3.5% rate to take on a 6.5 to 7.5% rate either, right?
Yeah, I think exactly. And I think a lot of the messaging that has been around, and I've said this for years, ultimately when companies like LendingTree came out, right? And they started focusing solely on, we're going to find you the best rate. LendingTree does it, Bankrate does it. So all of these companies, all they focus on is the interest rate. So when we've had 10 years of messaging around, you got to get your best rate, you got to get the best rate, you got to get the best rate, you got to get the best rate. And now we're in a situation where the rates are double of what your rate is. You're looking at it going, there's no way I can do that. But I think that loan officers and real estate agents throughout the industry are doing a really, really good job with messaging. And that messaging is finally starting to break through, where they're starting to realize the primary residence isn't about the finances. The primary residence is about making sure that your family's comfortable and safe and secure, and you're in a situation where you don't have 3 kids living in the same room, and the size is for what you need it to be. And that's the messaging that's finally coming across. Is when we were in 2.5% and 3% rate, every single loan officer in the world is going, I got the best rates, I can beat whatever, right? Because everybody was eating each other. Right. Now the market's eating most of the lenders, right? We're watching lenders fold up shop left and right, get bought left and right. And it's because they focused on interest rate for so long. They don't have any other marketing techniques.
I would argue too that part of, sorry, go ahead.
So just the good loan officers that are out there, or the good, real estate agents, they've focused on other things besides the rate. And now they're winning because they've built the practice up of doing it.
Yeah, those are all amazing points. And I'll add to this too, because, being in the business for over 20 years, I've always focused, I've been a purchase driven shop. So I've always wanted to help first time home buyers. I always like to educate and help people get in their first home, and then second and third home, obviously. And refinances to me were kind of like icing on the cake, because you can't control the market. So if you're focusing primarily on refinances and trying to help people save money, in essence, it's a good idea, right? But it's not a long lasting way to create a business that's going to help people in the long run, because you're never going to be in a perfect rate environment. You're always going to you find yourself in places of volatility. And so I think it is important to, at least for us, and I think we both agree, I want to say, if I pulled up numbers, I'd be close to 90% purchases over refinances. Obviously, when we start to finally see some ease in that bond market, and we start to see the rates getting to a point where it's a little bit better maybe to look at a refinance for some people, because a lot of them, to be honest, they're not ready to refinance unless they're in high interest credit cards, which is certainly a benefit. We're still doing refinances, guys. We're still finding great rates. The issue is that people that have been, post-COVID, they're getting these rates that were probably rates we'll never see again, to be honest.
No, absolutely never see.
They were definitely inflated, or deflated rather, by the government. They were pushed down purposely. I do think that we will see that quantitative easing in the future, as soon as we start to recognize that we may be in a recessionary environment. We've seen GDP growth go down. We've seen the tariffs kind of shake up the market a little bit. So do you think that quantitative easing is going to start, and do you think that that's in turn going to push down rates like I do?
I follow quite a few financial people on a bunch of the different social platforms, obviously. So, and I try, and you and I talk about this all the time. We try to get both sides of an issue, right? Because whatever you're searching for, you're going to find it, whether it's positive, negative, otherwise. If you want to find an answer that supports your decision, you're going to find it. And so, especially as financial professionals, we really have to dive in deeper on that and understand, maybe just because I think it doesn't mean it's true. So maybe let me read the other side and figure it out. So I say that as a buffer to what I'm saying, because I'm going to go, and this is the direction I believe it to be going in. I watch a lot about global liquidity, which, we can go as deep as we want to on that, but we watch the money
supply, right?
Yeah, watch the money supply start flowing in, right? And ironically, right around January of this year, the money started flowing in. And so we're in a situation where we've now reached new all-time highs consistently week over week on the money supply. And there's obviously a lag to market on that. And we're just waiting for that to catch up. And so we don't know what the time frame offset is. It could be 85 days, which is where we're at right now. And it could have started 2 days ago, or it could be another month or another 2 weeks. We just don't know when it's going to hit. But once it does, you're going to start watching things go crazy again, just like we did. And it's just the way that the cyclical markets work. And we watch it, cycle after cycle after cycle. And there's going to be certain assets that work out really well, and other ones are going to fold up shop. And it's we're going through another cycle just like that. And a lot of times what happens is after that cycle kind of trails out, guess what happens? Real estate goes crazy. And real estate goes crazy because all of that money needs a safe haven. And what has been the traditional safe haven over year? Real estate. And so, we watched that kind of happen. And, I threw a bunch of technical words out there and stuff like that. But basically money flows in, money flows out, money flows into real estate. And it's kind of the way that it's looking. So I have a feeling that, quantitative easing, as you mentioned, whether they're going to have to inject money into it or whether they're just going to start easing on rates, we just don't know. And I think that's what we're seeing such volatility, right? Is for so many years in a row, the status quo was kept. And so we knew what to expect. So when the news came out, yep, you're right. It was exactly what we expected. No reaction at all. It's already been priced in. What's next? Now they're sitting back going, the money's kind of on the sidelines going, I don't know where to put it because I don't know what's coming next. Right. And whether I believe that's by design as well, but that's why we're watching these massive swings in treasuries, in bonds, in stocks. Like you're watching, arguably the shift in up or down percentage wise. I think we've seen 5 of the worst or best 10 days in the market in the history of the market, over the last 2 months. Like that's crazy. Like you're watching possibly one of the most volatile times ever in the stock market, and no one really knows what to expect.
So it's kind of disappointing, right? When we're looking for answers and we're looking for information and you go on in the mainstream media and they're never really telling you the story that's actually happening. What are they doing? They're looking for sensationalism. And I'll give you a perfect example, and I'm not going to mention names, but there's a lot of real estate economists that have been screaming about a real estate recession or depression that's been going on for almost 5 years. And when you're looking at the data and you're listening to people that are in the business like we are day after day and following analysts that are strictly looking for what we're trying to determine is best for our clients and getting the correct information out, it's completely the opposite. We had, I think one of the economists has said that they were going to expect like an 11% decline in real estate appreciation. It went up 7%. So they were off almost 20%. So I think you brought up a good point about the markets and how they are cyclical. So, the past never really tells us exactly what's going to happen, but a lot of times it rhymes. So we can follow cycles and really determine what direction that we're going. And the other thing about markets, when you talked about global money supply, you talk about global markets, like everything is systemic, meaning they're all connected in some way. Maybe not directly correlated to each other, but when you start to see the signs and you see multiple situations happening that could affect the real estate market directly, I think those are the things that we want to be paying attention to so that we can inform clients, real estate agents, and other people in the business, what direction that we think things are going to be happening. I'm excited for the future.
One thing that I wanted to add to that, Jason, so that's great. Everything you said there's great. Like I think that's exactly the direction and what could happen, what might happen. But what I want to say is generally the people that make the most money are the people that act in times like we're in right now, right? The people that come out ahead are the people that respond in times of extreme fear or uncertainty. And you watch it year over year, cycle over cycle, as I've said throughout this messaging, like literally, this is when you're going to make the most is if you act now. And you might not see it immediately, right? Like it might be 10% drop next year. We don't know. But you also might see a 20% increase in your property value like we did I'm in Tampa Bay area. I think it was 20 and 21. We saw 20+% appreciation both years. Yeah. Which means if you bought a $400,000 house before COVID or right before COVID, you would have seen your house appreciate by $160,000. So like I said, if you're looking at all at trying to capitalize, when people are uncertain or fearful, Warren Buffett says it all the time, buy when people are afraid, right?
When there's blood in the streets.
Yeah. And that's when people that make the most, that's where the smart money starts to move. And I think there's a lot of smart money sitting, waiting, tipping, looking just for a tip of a sign, or they're already in and they're just waiting it out kind of thing.
Yeah. I always like to say I'm smart because I listen to people a lot smarter than me. And someone really smart told me, You know, why is Wayne Gretzky one of the best players in NHL history? Because he didn't skate to where the puck is. He skated to where the puck was going to be. And I think that speaks volumes on the understanding of markets and where the real estate market is actually going to be, going in the future. I would say this, for people that are a little bit unsure of what's happening and they're, maybe just afraid to buy right now because they're seeing the stock market, the 401k dropping. Well, just remember that when stock market and risk on assets decrease, it's actually a good thing because, like you said, safe money goes to bonds. Bonds rise, rates get better, right? And so we are constantly monitoring the real estate market and rates. But I would say that the most important thing for folks right now is not necessarily, hey, what are the rates doing this week? It's, hey, what is my payment comfortability right now? What area that I want to live in? Find a price range. Let's figure out where the rates are today, and let's work in reverse and see what you can afford. I think that's the best approach when it comes to volatile rate environments, in my opinion.
Absolutely. And I also believe, the idea of, you brought it up like in a passing movement, but utilizing the home equity that you earned, because to this point, you've got nothing but positive. Like, let's take advantage of it while it's there, right? Like if there is a 20% downswing, you're locked into that loan that's, holding most of that equity to yourself instead of losing that 20%. And you only lose it when you sell it, but you lose access to 20% of that, right? So, if you've got, and just for simplicity, if you got $100,000 right now, you could probably access up to 80,000 of it. But if you lose 20% of it, now you're down to 80,000. Now you can only access 65,000. What would you do with that extra 15? And so, we're seeing a lot of clients just open home equity lines of credit to have them open and have access to the money. Or, like you mentioned with the cash out refinance to pay off credit cards or high interest loans.
That's right.
There's a guy in our system right now that even after this large swing, because we were talking that week when it was on the downswing and then it spiked back up, even after the spike back up, he's still saving over $600 a month on the cash out refinance.
Yeah.
And now we're just waiting it out for like the middle ground, right? Like, we'll get lucky if it goes all the way back down, but anywhere in between we're looking and we're going to hammer it in. But $600 a month, like, think of the difference. When I think that's something that a lot of people don't think about, and it's something that I've really been focusing on a lot lately in my conversations.
Yeah. And that's why sometimes interest rate doesn't matter.
Exactly.
If I made 200%, but I have an 8% rate. I remember the advice that went out when rates were peaking. Real estate agents and other mortgage guys would say, date the rate, marry the house, right? Mm-hmm. And it sounded great. It was a nice tagline when rates were at 5.5% and 6%. Well, what are they saying now? So I think the important thing is, when you're looking for a house, just make sure that today's rate is giving you a payment that is comfortable for you and your family. We can always look at refinancing. Do I think rates are going to come down? Yes. Do I think the real estate market is going to crash? Absolutely not. Is there data to back it up? Absolutely. We have some of the most equity we've ever seen in houses right now. Mortgage delinquencies are still at decade, I think 20-something year lows. I don't think we're going to see a bunch of foreclosures. I think that the equity is there for people to get out of bad situations. And I think that there's only good things happening right now. Obviously, we need to see the dust settle. We need to see this tariff thing kind of settle down. We need a lot of things happen on the global structure to potentially see things happen. But here's the thing, guys. These markets move really quick. And as much as we study the markets and as much as we listen to really, really smart people, the reality is nobody really knows when. We can see that the trend is going to be lower rates, but it could be 6 months. It could be 3 years. We just don't know. So, my advice, listen to people that follow smarter people. Like, that's the way that I do my thing. Like, I do as much studying as I can, and I listen as unbiased as I could to people that know a little bit more than me, not only the real estate market, but the bond market, watching commodities, watching what the dollar's doing. All of it is connected. And as we see things progress, I think it all translates to a stronger real estate market. And I think we'll see some really, really higher volume and lesser volatility in the future. Yeah. Hey guys, thanks again so much. And Look forward to doing another podcast with you. And if you have any information that you want to hear about, let us know. We're looking for people to come on our podcast, right, Ryan?
Yeah, we're always open to have real estate agents. We love tapping into real estate agents and having them out there. Jason, I think you got a couple lined up to speak with, and I do too.
Got some going on. Got some real estate investors. Have some builders I'd like to talk to as well. Seeing how the applications and building permits. Let's kind of see what that's going on. So just a lot of cool things going on, and love to get some more folks on. So if you're interested in coming on and talking with us, debating us, bringing on information that maybe we're not bringing value.
I love it. Please tell me I'm wrong.
Tell me I'm wrong. We'll do a grind my gears. What really grinds my gears about Jason and Ryan? Bring it on, guys. We want to hear it. Anyway, thanks again, and we'll talk to you next time.